A choice of audit methodologies. The audit strategy describes the overall approach that the auditor will take to gather sufficient, appropriate evidence in an audit. A detailed audit plan can then be developed in the context of the audit strategy. The strategy may adopt a range of methodologies depending on the particular circumstances of the audit. Several possible methodologies are available for developing the audit strategy, including an audit risk approach, a business risk top-down approach, a systems-based approach, a transaction cycle approach, a balance sheet approach, substantive testing. These methodologies are not necessarily mutually exclusive, and they are likely to be used in combination to form the overall audit strategy. For example, although most of the work on a particular audit might be systems-based and focused in the highest business risk areas, the auditor will also carry out some substantive testing on all material balances and transactions. The different approaches describe the emphasis of the audit strategy and where the auditor expects to find most of the evidence that they need to reach an audit opinion about the fair presentation or true and fair view in the financial statements. Risk-based strategies, audit risk, and business risk. An assessment is made of the likelihood of material misstatements in each area of the financial statements. This is based on the auditor's understanding of the business risks faced by the client. Areas that are assessed as high risk are audited extensively using the various methodologies described below. Areas assessed as low risk are given a low level of attention in the audit, thus saving time. Business risk and audit risk are linked in that the areas most susceptible to material misstatement and hence audit risk are likely to arise from areas of greatest business risk. Systems-based approach. The audit focuses on the application of tests of control to the systems that produce the figures in the financial statements, rather than on the figures themselves. The systems-based approach is driven by the transaction cycles including sales, purchases, payroll, and other expenses. A systems-based approach is supported by some degree of substantive testing due to the unavoidable limitations or weaknesses in internal control systems. The amount of substantive testing required will depend on the auditor's judgment about the effectiveness of the internal controls. The systems-based approach is also supported by the use of analytical procedures. It is more cost-effective than a fully substantive testing balance sheet approach, but there is still a danger of doing too much unnecessary auditing of areas where controls operate well. Transaction cycle approach. The transaction cycle approach is similar in many ways to the systems-based approach because it is based on the same transaction cycles, sales, purchases, payroll, and other expenses. However, the transaction cycle approach adopts substantive procedures to test the transactions that occur throughout the cycle rather than testing the controls over the cycles. Systems-based and transaction cycle approaches are often combined within the overall audit strategy. Balance sheet substantive approach. The balance sheet approach is fundamentally based on the accounting equation. The basic premise is that if current year-end and prior year-end net assets are fairly presented, then it is easier to gain audit comfort on the intervening profit and loss and other changes in equity, thus resulting in reduced procedures on the income statement. This approach focuses on applying substantive tests to a large number of transactions and account balances recorded in the accounting system of the client in order to prove year-end balances. Implications of choosing any approach. If the auditor focuses purely on recorded transactions and balances, then understatement may not be detected, i.e., the auditor may ignore transactions that have not been recorded. Therefore, directional testing must be employed as part of the substantive procedures based on whether the test addresses over- or understatement. This approach can be time-consuming and costly for the audit of large companies. This approach is appropriate where systems and controls are weak or not operating effectively, thus rendering substantive tests on transactions and balances necessary to reach an opinion about the financial statements. It is widely used for the audit of smaller entities where controls are less likely to be developed or effective. There is a danger of spending too much time auditing transactions or balances that are not material and/or have a low risk of material misstatement. There is also a risk that misstatements in the financial transactions will not be detected unless all transactions and balances are tested, not just a sample. Factors in the choice of audit strategy. The development of an audit strategy will depend on a number of factors, including the nature and size of the client's business. A business risk approach is best suited for large companies, and a balance sheet approach is usually the most suitable for small companies. The control procedures and control environment in place. A systems-based approach is most suitable when there is a strong control environment and internal control system. The audit methods and techniques favored by the audit firm. For example, larger audit firms may favor a business risk approach. You may be asked to select and justify an audit strategy for a particular client in the examination, in which case, students would be considering factors discussed above. Throughout our session, we will be using the risk-based and systems-based approach.